My name is Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business News, and the Wall Street Journal. And in those media outlets, I've commented on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to even make you a millionaire. But I am here to help you learn how to take control of your finances, manage your own portfolio, and most importantly, manage your own risk. I've traded in most markets throughout my career on the floor of the Chicago Board of Trade. Basically traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products. This is an educational company, and I'm here to help teach you that you don't have to rely on anyone else. I'm going to teach you rules to implement trading strategies into your own accounts. But having said that, I need to go over a couple of disclaimers. This disclaimer talks about everything that I mention in these videos is hypothetical. Because if someone were to watch this 2 years down the road, or even 2 days down the road, the strategy that I talk about, if I were to give a specific example, would not necessarily be the right strategy to implement at that time. Facebook, for example, if I gave an example of that and 3 years down the road, that price is likely not to be at the same price that I talked about during this video. So everything I talk about is going to have hypothetical situations. This goes on to say that this is an educational company, but having said that, I'm here to teach you the strategies to implement into your own account. I don't know what you have already in your portfolio, so what I talk about, if I were to give a specific trading strategy, you need to figure out if that's actually right for your risk parameters, your portfolio, and everything else that you've got going on. But what I am going to try and do is teach you. And the bottom line is, you need to do your own homework. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. I'm sure you've all heard that before. Welcome to Options Basics. This is part 3 in a series of several different video presentations that I'm going to be talking about options basics and different types of ways to implement options into one's portfolio. If you are very new to options, then go back to part maybe 1 and 2 and learn a little bit of the terminology that I'm going to be using throughout the rest of these video presentations and get a little bit background. If you are a little bit further advanced, know your options terminology and are basically to start getting your feet wet with options, then you can start here and follow along with me. I'm going to be talking about different types of option strategies that you can implement into a portfolio that you have already, which is generally going to be consistent of different ETFs, mutual funds, and outright stocks. So why implement options into a portfolio? It's because they're very versatile. What we're going to be talking about in this series are the ones that are going to be conservative and protect the returns that you've already had. So if you've had stocks in your portfolio and they've run up quite a bit since you've implemented those stocks or since you bought those stocks, then this is going to be a time where you may or may not want to be a little bit more conservative or protect some of your returns. In the later options basics classes, I'm going to be talking about ways to generate more income through the use of options. But this one's going to be specifically for the more conservative investor and looking to take some options and protect some of the gains that they've already had. Options are amazing and versatile tools. They can be very speculative and high risk and give you spectacular returns. On the other end of the spectrum, they can be very conservative, produce consistent double-digit returns, and serve as tools for portfolio management. This is what I mean by portfolio management or portfolio protection. You can apply option strategies to traditional portfolio of long stock positions. Remember, those are stocks that you own because you expect them to go up in price, to manage, reduce, or even eliminate some of those risks. For example, you can buy puts to play a bear market. For instance, right now we're seeing historical highs, and many people out there are a little bit nervous. This means that you can avoid high risk of shorting a stock because, who knows? People have been talking about this market sell-off for a year or so now, and the market continues to make all-time highs. And that would be very risky. But if you're long the puts, you can still profit from the falling market. There's just no other way to do this so safely. Risk management has become one of the most exciting uses of options, as well as focused on the huge increase in options trading in recent years. This is really a huge trend. As we know, Lees from Leadus started options 2,000 years ago with his olive presses, but they were standardized in 1973 with the Chicago Board of Options Exchange. And since that time, when they traded only about 1 million contracts in that given year, today, over billions of contracts per year are traded on these various exchanges. So it's becoming a huge trend in just over 40 years. The strategies I'm going to talk about today for portfolio protection when you're long the stocks, or when I say long the stocks, that means any asset or underlying. I'm going to sometimes refer to them as stocks, but know that if you have an ETF or an index or a bond, that could be the underlying. But we're going to sell covered calls against our long position, buy puts on an outright, what a collared strategy is, and how to replace stocks with options. Why would you replace stocks with options? We'll go into that in a little while, but know that options take less margin. So if you own $200 stock and you have 100 shares, it's going to cost you $20,000 to purchase that. Whereas if you own a call, it's going to cost you a lot less. Selling a covered call. It's probably the most popular among the beginning options traders for the most part. And how do you implement this? The owner of 100 shares or more of a stock sells or writes one out of the money call for every 100 shares of stock owned. So if you own 500 shares of stock, that's 5 calls. And I wouldn't necessarily suggest that you put every call on at the same time, but you can average your costs, especially if you have more than 100 shares. You can't really do it if you only have 100. The seller or the writer of the option receives the premium but sacrifices the possibility of earning profits above that strike price sold. What does that mean? Well, if you are the seller of a call, remember that the buyer of that call can call you to exercise. So that means that you would have to sell your stock or sell the underlying to the buyer of that option. So it kind of puts a cap on your upward movement on this. But selling a covered call is usually for a person that is trying to protect profits. So selling a covered call, and why would you want to implement it? Because you get cash now for profits that may never be reached otherwise. So if I sold a call, which is going to be out of the money, I can increase synthetically the price of or the yield, I should say, on my stock. So if I've owned stock at, say, $50 and we're trading around $70, whatever premium I receive increases the value of where I really bought that stock at synthetically, which overall increases your yield. And as a replacement for a GTC, or good till cancel order, which would be if you put an order in at 79 for a stock and you wanted to get out of it at 79, well, if you sold a couple of calls at a strike price of 79, then if it got there, you would actually be exercised, have to sell your stock at 79, but you also synthetically sold that stock at a much higher price because of the premiums that you've received. Covered call guidelines, and these are going to be guidelines that we use throughout for the most part. Use shorter duration options contracts. You don't want to use the long term or the leaps. You want to use shorter duration. The reason being is this is going to take advantage of time decay and the volatility and things of that nature, whereas you're not going to get that decay very quickly if you use longer duration options contracts. Shorter, like I said, shorter duration options contracts take advantage of the decay and time value, which is the theta, at a greater rate than the longer duration options. Although you will receive more premium for the longer duration contracts, you will also see accelerated theta decay in the shorter duration contracts, thus making better returns in the end. Also, the longer term options contracts will tie up your money for an extended period of time, causing an increased risk. You can also use the shorter durations several times throughout. Taking advantage of that theta decay will outweigh the longer term options contracts theta decay given any particular time frame. And we're going to talk about correct strike selection. This is part of the art of options trading. And I'm going to go into these in a lot more detail in the in-room classes and the online webinars. So if you want to find out a little bit more about that, we'll talk about that at the end. Choosing the right out-of-the-money strike can make the difference between good returns and no returns. Choosing an at-the-money or an in-the-money option is likely to get you exercised. Remember, when you're selling out of the money, you're collecting the extrinsic value, which is really made up of the time decay or the theta and the implied volatility or the implied volatility rank that's embedded inside of the extrinsic value. But if you're choosing an at-the-money or an in-the-money option, you're likely to get exercised because as soon as you're in the money, somebody might want to buy that a little bit below the market and just pay the intrinsic value, which would put it right at the price you're trading at. So really you're kind of just entering a market order, so to speak, when you put those below the market on your calls. Be mindful of the dividends and the earnings. These things can really take a lot of studying to figure out why the dividends and earnings are going to affect it. But for the most part, dividends and earnings are going to pump up the value of the options contract, which could increase the volatility and things of that nature. Some of those things we will take advantage of, especially in more advanced options strategy classes where we might put on an earnings play for only a day just to take advantage of that accelerated implied volatility going down. If there's a pending dividend, you may get exercised simply for the right of the buyer to take advantage of that dividend. And the closer you get to earnings announcements, you will see the implied volatility, which is what I talked about a little bit ago, and the effects of Vega that could counter the effects of theta. But like I said, in the future, we are going to be talking about how to take advantage of the Vega decay right before earnings. And choose profitable positions. What does that mean? Of course we're going to choose profitable positions. It's picking the strikes above your basis in the underlying so that you can lock in profits rather than a loss. Well, if I bought, ABC stock at 50 and we're trading at 40, I wouldn't want to lock in a loss on that stock by selling a 45 strike and then getting exercised if the market came back a little bit. The exception to the rule is that the amount you receive in premium offsets the loss in your stock position. So in this instance, let's say I bought ABC stock at 46 and then I sold the 45 call for $1 intrinsic and $1 extrinsic, then that would synthetically have me selling that stock for $1 profit. So choosing the right underlying. Highly volatile stocks are going to increase the premium received, but it's also going to increase your risk. There's another little thing that I wanted to add to this is choosing the right underlying when trading options is choose one that has a lot of volume, or one of the most popular options out there would be something like Tesla has a lot of open interest. So find the ones that have a lot of open interest, because those spreads are going to be tighter. The bid ask on that underlying is going to be a lot tighter than if you choose XYZ stock that nobody's ever heard of. Those spreads are going to be a lot wider. Little example of that would be, if you wanted to buy what's the most popular car right now, either a Tesla or probably a Range Rover. I think there's a waiting list for a Range Rover for over a year right now. So that's a very popular car. So that you're not going to be able to negotiate the price because it's popular. Whereas, something along the lines like the Pet Rock, that price you can probably negotiate a lot easier, because nobody wants the Pet Rock anymore, or say patio furniture, or something along those lines where somebody needs to get rid of it seasonally. You're going to have a little bit more negotiations in the fall when somebody needs to offload a lot of their patio furniture because they don't want to carry it over the winter. So you might have a little bit more negotiating room. You're not going to have to pay the offer price that they're asking. You could probably come in and say you wanted it 50% off, or middle it, something along those lines. You'll be able to get a discount. So I guess in that instance, the more popular stocks, you're going to have a tight market because people are willing to give up more of an edge, whereas in the ones that aren't popular, you're just going to have to wait it out, or you're going to give up a lot of money buying and selling those, because you're going to be hitting the offer and selling the bid, and that's going to eat away at your margins.